Hello, everyone. I'm Paul Washington, Executive Director of the ESG Center here at the Conference Board. The ESG Center focuses on issues of corporate governance, sustainability, citizenship, and philanthropy. I'd like to welcome you to the latest edition of Governance Watch, our webcast series that we hold in collaboration with the law firm of Cleary, Gottlieb, Steen & Hamilton. Today, our focus is on shareholder activism. What happened in 2019, what it means for 2020, and what companies and others should do now to prepare for the days ahead. So we've all seen the headlines in the past year about shareholder activism, and some of you watching today have lived through them. But today we're going to go beneath the headlines to talk about the underlying drivers of shareholder activism and provide some practical insights for what's ahead. Today, I'm really delighted to be joined by three experts in the field. We've got Jim Langston, who's a partner at Cleary, Gottlieb, Steen & Hamilton. Welcome.
Thanks for having me.
We have Sharon Stern, a partner at the firm of Joel Frank. Sharon.
Good to see you. Thank you.
Delighted you're here. And Pete Michelson, who is Head of Activism and Shareholder Advocacy for the Americas at Goldman Sachs. Pete?
Glad to be here.
Great. So before we begin, I've got some housekeeping items to go through, so please bear with me if you would. First, we and New York State's CLE credit for participating in the entire webcast. For those who want CPE credit, you need to enter your full name, email address, and specify CPE in the Request CPE Credit space at the bottom of your screen. Please note that 3 pop-up messages will occur during the program to confirm your participation. Please click OK each time you see one of those. For CLE credit, please download the CLE verification and evaluation forms posted in the Download section at the bottom of your screen. Complete the form and then email them to our friends at Cleary Gottlieb at the email address provided on the forms. I'll provide a verification code later in the webcast, which you'll need to write on the verification form to earn CLE credit. Second, I want to underscore that we really invite audience participation today, so you can ask questions at any time by entering them into the chat box at the bottom left of your screen. We'll try to work them into the conversation today, and if we don't get to them today, we'll post the answers afterwards. Finally, a few other housekeeping items. You can download an excellent deck put together by Cleary Gottlieb from the presentation today. It's in the Download section at the bottom of your screen. Please complete an evaluation form about this program. It's separate from the CLE verification form, because we'd like to hear from you and then incorporate your feedback into future sessions. You can share this program with your colleagues. It'll be available on demand in a couple days after this live webcast. And finally, if you want to see us full screen, you can enlarge the video by clicking on the 4 arrows in the upper right-hand corner of your screen. And now with all that important stuff out of the way, let me briefly set the stage for our discussion today with some of the headlines from the past year. You know, at the very highest level, we've seen some stabilization in the area of activism in the past few years. According to FactSet, which may not capture the entire picture, there were about 187 companies that were targeted last year with $42 billion in capital deployed, which is fairly consistent with the multi-year averages. But beneath that top line, there have been some really notable trends that could shape activism looking into 2020 and beyond. First of all, activism has gone global. It's no longer just an American phenomenon, but we're seeing an uptick in Europe and Asia. Second, there were a record number of activist campaigns, 99 relating to M&A. We'll get into that more. Third, ESG activism has really gone mainstream. Fourth, we've continued to see an evolution in the players in this area. So traditional long-only firms are now becoming more publicly activist, and there's been a bit of convergence between private equity and hedge funds in a way that we haven't seen as much as in the past. And finally, the dynamics of activist campaigns are changing, particularly when it comes to some of the large cap deal related activism. And in some other instances, you're seeing not settlements so much as ceasefires. So the activists remain in your stock and they're there, and who knows when they'll resurface. So those are some of the sort of main themes. And now we're going to drill into each of those. So Pete, let's talk about this global phenomenon. I don't know if it affects our balance of trade, but it seems as if U.S. Activism is being a little bit exported overseas to Europe and Asia. So what's happening, and do you expect that to continue?
Yeah, so that's absolutely a trend that we've seen over the past several years, and it makes, I think, Americans a little bit less popular abroad in corporate boardrooms, and because activism fundamentally speaks with an American accent. Mm-hmm. Most of the tactics, a lot of the capital that's deployed comes from American funds, and the key driver, we believe, for moving offshore is that the market, it's not necessarily saturated in the US, mm-hmm. but a lot of the lower hanging fruit is picked over. And so while moving to Europe or moving to Asia has some idiosyncrasies that you have to deal with, whether it's shareholder base or regulators or government, people view the prize there to be significant enough they want to deploy capital, mm-hmm. particularly at the large and mega caps side of the spectrum, to take advantage of what they see as market inefficiencies. And so we've seen that with respect to Europe for several years now, mm-hmm. And whether it's Merlin or Rolls-Royce or ThyssenKrupp or any SAP, number of situations across Europe, and then of course the significant bumper crop in Japan this year, particularly this year, as well as Korea. And what you'll notice is most of the companies that they're targeting, they're global companies. Mm-hmm. So their top line is not bounded by how how France or Germany or Japan is growing. It's the global economy. And yet they typically trade several turns lower than US companies. And that may be, again, there's not enough of a spotlight shined on them, but it also is there may not be as focused of cost efficiency mm-hmm. Measures or inefficient capital structures. And so folks are seeing the ability to go outside of the US and take advantage of that, although they do end up being a little bit more on the constructive side because, again, slash and burn campaigns, proxy fights, and things of that sort remain relatively unpopular in most ex-US jurisdictions.
Interesting.
Yeah, I think the global phenomenon you touched on is the right one. And a lot of those companies that are being targeted, the shareholder complexion, investors at those companies is also different, right? I mean, they're more prone to have U.S. or either European investors who are more used to, at this point in the stage, holding companies and boards accountable, willing to be more forceful in that regard. And they also expect more U.S.-style shareholder returns and capital allocation policies. I think from an activist perspective, when they look at it, they think it's more fertile ground for activism.
Right. And so do you think there's a chance that, investors from outside the U.S. might start to become more active in the U.S. to redress this balance of activist trade?
So that's a tough question, and you historically saw some movement from ex-U.S. into the U.S. I think about the Children's Fund campaign at mm-hmm. CSX and a number of other situations historically. But if I look at a Sevian or KCGI or Oasis or any of the activist funds that specialize outside the U.S., one of their advantages or competitive advantages is really that they understand the local shareholders, that they understand the markets, mm-hmm. And that they can use soft power to affect change in those jurisdictions. And so they have less of an advantage coming to the U.S. And if the baseline assumption is that the market is more picked over here, right. Then it's possible that they may move to the U.S. or they may target companies in the U.S. I just think that there's less of an impetus for them for inbound versus outbound to the U.S.
Got it. Really helpful. But if you're a company headquartered outside the U.S. and you're truly a global company, activism may well be on the horizon.
You should be thinking about activism.
Yeah. So let's talk about deal activism, which really had a record year this year. I think 99 campaigns, as I mentioned at the outset, and it came in a variety of forms. You had, activists who wanted companies to do M&A. You had activists who were blocking announced deals, and then you also had activists come in after the fact. So the deal's closed, but it's not living up to the promise of the deal, at least in terms of the activist perspective. So, what's happening in the landscape here in deal activism, and are these enduring trends? And, how should companies be responding? Maybe, if you're thinking about you're negotiating a deal, is there something that you can do in the deal terms, Jim, that would, help fend off or help mitigate the impact of activism?
Yeah, sure. So you're right that there's been an uptick in deal activism last year. I don't think that's a surprise because deal activism is in many ways a reflection of the M&A market. And you saw still high levels of M&A activity last year, particularly on mega cap transactions, which we'll talk about in a minute. And you're right, deal activism has been with us for a while. It started off in bump-arbitrage style campaigns where an activist would buy a stake in a company that was being sold, often on the thesis that it was being sold on the cheap, and would threaten to hold up the deal unless the acquirer increased the share price. That still happens. That sort of evolved into this more, break up the company type activism, and you had activists looking at companies that did a lot of different things and saying that those companies traded at a discount to the sum of the parts value. And I think that was reinforced by this notion that institutional and other shareholders have that fit and focus is a good thing, and that if you break up the company, the higher value parts the multiple would expand and it would unlock value for shareholders generally. So that was the theme of those campaigns. And sort of the next wave of deal activism. And then it sort of morphed or involved into focusing on selling the company. Right? I think the Whole Foods sell to Amazon was really a catalyst for that. And from the activist perspective, it was in many cases a home run. Right? They had an investment for a relatively short period of time. Company gets sold at a premium. And when you take into account the derivatives or other leverage that they had in play, it really boosts their return. So it was a way for them to profit very quickly. And I think that became a very attractive thesis to a lot of activists and sort of following in the JANA and Whole Foods wake. There have been more recently, I think, a moderation in the campaigns to sell the company. Selling a company isn't easy to do. It can be disruptive if it doesn't happen. And there have been a lot of activists that have taken a big swing selling companies. Hasn't happened. Right. Stock price plummets, and all of a sudden it doesn't look like it was such a good idea. And I think many shareholders also, it's kind of hard to convince them that selling a company necessarily isn't a bad thing, right? I mean, from their perspective, it's great if a company gets sold, but as I said, it's disruptive and it doesn't always happen. So I think have seen less of that recently than you had in the past. But what you have seen more of, as I said, these sort of mega cap transactions. Very large transactions with stock components that often require shareholder approval on the buyer side. Activists, what's been new about it is they've bought into the stock on the acquirer side, and because often the buyer needs a shareholder vote, they've used that as an opportunity to campaign against the transaction, often on the theory that the transaction was adrift from their strategic plan, they were paying too much, or just didn't make sense. So there's been more of that recently, and certainly more of that last year. So that's the bad news. The good news is that almost all of those campaigns didn't succeed. Most of those deals ultimately got approved by shareholders, and there wasn't really a change in deal terms or other immediate repercussions. But it was a white-knuckle experience for boards and management teams, and put those transactions under the spotlight. So I think you had companies looking at those transactions and thinking about if there's a way to structure them that you don't need a shareholder approval on the buy side. So you cap the stock portion at 19.9%. So there's not shareholder approval requirements under the listing rules. So you've
Right.
seen folks be more creative and oftentimes target companies or companies on the other side of the merger pushing companies really hard to do that. You saw that play out in Occidental's acquisition of Anadarko. That was a unique situation in many respects, I think, because one, they were topping the Chevron bid. Chevron didn't have a shareholder approval, and so in order to get those two transactions on par from a deal certainty perspective, they had to do some creative things to get there. Ultimately, that deal closed. The shareholders had some frustration with it. I think there was a fairly high number of withhold votes at the annual meeting for the Occidental directors that came after the deal. So I think it's still too soon to tell whether or not that's something that is going to have shareholders be more forceful about it. You have Icon, who's running a proxy contest, and so the story's not over there. There have been other transactions that have closed, and then the transaction hasn't gone as planned. So you have, at least from an activist perspective, looking at those transactions, and boards and management teams through their eyes haven't delivered on their M&A promises. And you've seen that in the Starboard Dollar Tree campaign. You've also seen that at AT&T and Elliott's campaign there. So I think it's something that companies have to be mindful of. They should obviously still do M&A. It's a tried and true growth strategy in a way to really execute on the strategic plan. But I think where companies have gotten themselves into trouble is where the shareholders have been surprised by the transaction and didn't really expect it. Right. I think that's something that you'll see companies focus more on and being more careful in that regard.
Got it. So one thing in terms of deal structure is maybe avoiding a need for a shareholder vote on the acquirer side. But talking about how activism can continue even after the deal has closed and moving long away from the sort of bumbatrage thing. So what does that mean in terms of messaging, Sharon?
Well, I think and everything that you said, M&A is extremely complicated, and even the small deals have hair on them, and M&A isn't linear. So bumbatrage is not anything new, and it's cheap. It's easy for a shareholder to come in and kind of like shake up the trees a little bit and see if there's any more money that can come out. And a lot of times these shareholders and activists aren't really looking to break up the deal. They just want more money. But what we saw in 2019 was something a little bit different. What happened in one of the mega cap transactions that you're alluding to with the Bristol Myers and Celgene transaction. Wellington, which is a blue chip investor, came out vocally against the deal. And they came out before Starboard. So the company then at that point was faced with a messaging, I don't want to say dilemma, but it was a little bit different. If the company was coming out against Starboard, it'd be very easy to say, you're a new investor, you don't understand our strategy, you don't know what we're doing here, let me explain it to you. But you can't say that when you're talking to a Wellington who's been in your investor base for a long time. And you also have to appreciate with all activism and with the longs that if there's one out there who's being vocal, there are plenty more out there who aren't. So it turns into a bit of a messaging challenge or a different opportunity with the company. Practically speaking on this one, the company would have known going in that there were some potential longs that maybe didn't want to see Bristol doing a large transaction. And because of that, the board had to be very deliberate in its process. And they ended up getting ISS support for the transaction, even with Wellington out there. And a lot of the things that ISS looks at, and I know you guys can weigh in, is process. So if you have a good governance process in place, and if the deal is rock solid in terms of strategic value, financial value, and you can prove that to your other shareholders, you could overcome some of these other hurdles. But Wellington watershed moment, I don't know. We'll have to see if other blue chips kind of take that kind of vocal stake.
Yeah. And I just chime in. Wellington certainly was a very situation specific decision for them, and that was really because they were one of the few folks who didn't have a long position in Celgene, and they had a long position in Bristol, and by dint of not having that, they effectively underperformed their benchmarks because of that single deal. And so, and there was obviously strategic rationale that they were upset. But the approvals, as I understand it, the approvals that they had to go through to write that deed were extraordinary. And so I think that the message is less on Wellington and less that you're going to have, Fidelity or people as a matter of policy come out. It's just that it is a fundamental risk that there is going to be one or two large, high-profile, well-regarded, thoughtful investor who may differ. And so you need to be prepared. And going back to the messaging, we would always see, and I think the Joel team will basically echo this, is everyone scrambles to get the deal done. But when it comes to the announcement, sometimes people say, well, we'll put out the terms, put out a press release, and we'll see where it goes. That is a lost opportunity because as the ARBs, as folks jump in and try to understand the transaction, you need to be as forward-leaning as possible. You need to really message the strategy tightly. And I'll contrast, there was a large cap situation for a certain reason. They kind of underplayed the strategic fit, and it ended up, I think, causing a little more problems. It still got approved, but contrast that with a recent situation we had with a merger that was not that clearly synergistic, but we really actually leaned very far forward on a sustainability theme to sell that merger. It was, different products, same vertical, but there was a sustainability theme that made a lot of sense. And so you really have to sell that strategy in a way that's going to resonate. And finally, on process, don't wait until the background to the proxy. Yeah. Like if you're but that historically was the case, is people would wait until the proxy was published to see how the process had unfolded. And so that is one thing where you need to dedicate at least a page to, here's how the independent directors were involved, here's how we thought through it, this is why we came to this conclusion, because you need to nip that in the bud. Otherwise, you're going to have people front running the proxy and trying to make hay out of what's in that disclosure. So it's a really important position.
So you need to think through your process and your message from the outset. And frankly, you need to make sure as well that whatever you're telling your shareholders is what you're telling your board, it's what you'll tell your regulators, and what you'll tell your employees, what's out there generally in the public. And it has to be a consistent message, because you don't want to get crosswise with telling one story to your investors, one different story to your board, and a different story that you then tried to tell to the regulators.
And you also don't want there to be a vacuum,
right?
Yeah. Right. To your point, I mean, if there's a vacuum in communications on your side, it's going to get filled by a message
others
that you probably don't want to be told.
Exactly. So I would actually say messaging starts even before, obviously the rehearsals and the practice starts before the deal gets announced. But we've all seen it. Leaks are happening more than they've ever happened before. So the way the media and the financial reporting is the same as political reporting across the board. Reporters are incentivized to break news, to get out there. And the financial reporting has also been a lot more in terms of the news as opposed to the analysis. So because of that, the media becomes a little bit less influential with your constituents. They're still important because the communities read it. I think local probably becomes a little bit more important than the national press. But it also creates a great communications opportunity. So you have the ability to start communicating more directly to your shareholders, and companies need to just be a little bit more, I think, sophisticated in their deal rollouts and their announcements too. I mean, the press release is an important document, the investor deck is an important document, but it's more about the infographic, it's about the tweet, it's the social campaign that you have around it, because to your point, winning the hearts and minds of shareholders is one, but you also need to win the hearts and minds of your retail audience, your employees, your customers, and so forth.
Right. So it's not just stockholder capitalism, it's stakeholder capitalism when you're dealing with this sort of thing, right? Including getting a deal done. So we talked briefly about Wellington, but let's spend a little more time, if we could, on long-only activism. So you are seeing more traditional longholders becoming more public about taking stands alongside activists, and even sometimes in the lead. What's causing that, and do you expect that to continue, and how does the company respond? We talked a little bit about your message and response needs to be a little different, but what else might companies consider doing in light of this?
Yeah, and so I I'd go back to why is it happening
Yeah.
first, because I think that's the most important question. And it really the changes that we've seen in the market for activism, it is first of all because it's more prevalent. It's not as much of a crossing the Rubicon to if Wellington can do it and T. Rowe's done it, and Artisan. There's a number of folks out there who have taken relatively forward-leaning stances in the public, and so
the stigma's gone in some ways.
It's people are very deliberate about it.
Yeah.
And I would say that and I'd almost triage it with there's the folks who make a public statement and want to provide their views because they think it's important for the market to understand, which is more of a Wellington one. There is a more active campaign often around M&A. We've seen this happen for say T. Rowe. Where they are much more direct, either in support, against a transaction or in support of an activist, again, because they want people to know where they stand, and they also want, proxy advisors, other constituencies to understand that. And then there's the full-fledged, I'm actually going to mount a proxy fight. And, Neuberger is the case in point.
Right.
They've done that on, Barron, Ultratech, a couple other, so those are two situations in particular, which I think is much less frequent, and frankly, before we expect Fidelity to be running around running a bunch of proxy fights, their cost structure doesn't really work to in general mutual fund cost structures. It's difficult for that to underwrite a significant activist campaign. So I would think about this more as it's just about them putting into the market their position,
their views,
and it's part of the toolkit now. So that's the first question. Why are they doing it? It's not only that the cost is lower, it's also that there's a significant benefit for them, which is, on one hand, they're getting squeezed on cost by index funds, where historically active funds have underperformed the index. And so the question is, well, what value are you adding? Why should I give assets to you versus an index fund? And on the other hand, they have the activists out there that are getting a lot of ink about driving change. And if I'm a PM or an analyst at a long only fund, I'll often say, I've held this company for 6 years. I have 3 times the stake of the activist. I know the sector cold, and I have very distinct views. And so I should be out there, and satisfy my investors by deploying my stake and my knowledge to affect the right change. And so I think there's a desire for the long onlys to be more participatory, to prove value. And some of that is, again, happening just in normal course out of their normal funds. There are certain large institutions that have set up constant, the AllianceBernstein Concentrated Equity Fund is a good example of something that was kind of test piloted. There are a number of those strategies that may happen, but I see for the long onlys it mainly being a use of the public voice as part of the toolkit to supplement returns and create an understanding from their investors that they're driving value. Now, the final point really is, this goes back to the toolkit analogy, is for large hedge funds. There has been an increasing interest in deploying activism, not to become a primary activist, but if you look at D. Shaw as a great example, which has mounted a number of campaigns at very large cap companies, as well as some mid-cap companies. And from their perspective, they have a huge amount of capital under management. They have a lot of resources, and they don't need to hit home runs all the time. What they're looking to do is to enhance returns. And if this is one lever that they can pull by being more engaged, and we talked about the cost being lower for going public, then it makes a lot of sense for them to develop that as not as a specific strategy, but as something that they can lay across their portfolio. You look at the flip side, even some of the activist funds, which are, I think about folks like Third Point, which they have industry verticals, they have a bunch of different strategies. They are, in certainly less than the majority of situations are they activist. But they use that as a toolkit across those verticals when it makes sense, when they think they can drive returns. And so you're kind of seeing this convergence from the long onlys, major hedge funds, activist funds, where it's all converging and being more vocal, probably a little less aggressive and willing to be constructive, for a number of the funds.
That's really interesting. So, but that, in some ways, if you're sitting at a company, this isn't necessarily unwelcome, right? Because one of the challenges you can have at a company is you're dealing with an activist. Let's say you've got a deal going on or something that's happening. You know where the activist is, but it's sometimes helpful to know where your major shareholders are, your long-only folks, if they come out publicly early on, so that you're not surprised at the end of the process. And you also talked about everyone becoming maybe somewhat more constructive in this, as there's sort of no longer just the slash and burn over here and the sort of silence over here from your long-only, that people are now engaging more of kind of a constructive approach. So not all bad news from a company's perspective, right?
It provides more direct feedback,
Yeah.
and so it becomes noisier, and it becomes a multi-party negotiation
Right.
or dialogue that becomes much more complex.
Right.
But I'd personally prefer that because it's a principled discussion,
Yep.
as opposed to a bilateral discussion where you have a couple people off the frame where you might not know where they stand, and you might be surprised at the end.
Right.
So again, you may not like what you hear, but at least you're working with better information than you were
Right.
5 or 10 years ago.
Yeah. So three-dimensional chess, but better to know you're playing that game from the outset than just be surprised partway through, right? When
Absolutely.
two-dimension goes three.
Companies should always know where their shareholders stand.
Yeah.
I mean, it's good IR at that point. And when you think of activism, it's like IR on steroids. It's doing all the things that you should be doing as part of your normal communications, investor relations, corporate governance program, but you're doing it in opposition potentially. So, a lot of times advisors will come to a company and say, be your own activist. Take stock of what you're doing. Look at yourself from the outside in, how others might be perceiving you. So we're talking about longs only acting more active, which is true if you think of, a Wellington or a D. Shaw, so forth. But really, they have always been vocal in the way that they can vote and in the voting guidelines that they set up. So even if they're not coming out to you publicly, they're certainly talking to you privately, or at least would be. And you have Vanguard, BlackRock, State Street. I mean, you have the three majors that own probably collectively like 20 to quarter of like the S&P 500 of any stock. So you would really need to know where those shareholders sit, because if one is there not liking what they're seeing or not understanding the strategy, it doesn't matter if you're doing a deal, if you're doing an asset sale, if you're restructuring, you would need to know to be able to drop the tea leaves, so that way the investors see where you're going and what your strategy is.
Right. Though sometimes it's hard to get that information from your shareholders.
Yeah.
You can do your best, and they sometimes
Yeah.
change over time. But again, the greater the transparency and greater preparation, the better. So we talked about long only and hedge funds. So let's talk a little bit, Jim, about private equity. So traditionally, if an activist was in there advocating for the sale of all the company or part of the company, private equity was there to be the buyer. So kind of a nice kind of match made in heaven. But now private equity is getting more into the activist side. So what's happening?
Yeah, no, you're exactly right. I mean, it started with folks like Thoma Bravo, Vistas, or riding in the wake of Elliott and other activists and picking up deals that way. And you still see that happen, but for a number of years now, people had predicted that there was going to be this continued convergence of activism and private equity, and the lines would get blurrier. That's been slow to happen, I think, but it's been accelerating over the last 12, 18 months to 2 years. I think a lot of it has been more towards the lower end of the value chain, sort of small cap, mid-market transactions. You've had private equity funds or quasi-activists be more aggressive in putting companies into play, acquiring toehold stakes, filing a 13D, really rattling the cage to acquire those companies. And that happened. It's still happening. But over time, you've seen some of the name brand activists start to act more like private equity firms in their approach and their objectives. Starboard and Elliott are two that come to mind. Starboard's investments have been more pipe-like, and I don't know if you want to call them rescue financings or helping solve a liquidity or cash crunch at companies, but they've been deploying that strategy. Saw them do that at ComScore and Papa John's as well. And Elliott's been sort of a private equity-like player unto itself with its Evergreen Fund, and more typically they're teaming up with either more established private equity players or sovereign wealth fund to sort of broaden the capital that they have to deploy in buyouts and allow them to acquire companies with larger capitalizations. You see that happening as well. I mean, Tryon and Icon have been doing that for years, but they're very different both from themselves, each other, and the other folks we've been talking about, investors. So I'd put them sort of in a class of their own. So you've had that theme going on, but I think you've also seen private equity funds wanting to be more like activists, or at least deploying a portion of the capital that they've raised in what they call constructivist-like situations. And it's not all that surprising. Private equity funds have been acting more aggressively in general. We're seeing them more frequently deploy bear hug letters. They don't usually go public with them, but they'll submit a letter offering to buy a company for a certain price. That way the CEO has to take it to her board, talk about it, and trying to catalyze transactions that way. Those often are accompanied by leaks. And so there's been more aggressive behavior from them on that front as well. But they've started to do more of the activist-like investing. And some of that is involved using existing funds that they have out of their buyout funds or credit funds to sort of make constructive investments. But they've also been trying to raise dedicated funds. And most of the folks that are doing this are the large cap, more established private equity players. And it's not all that surprising to me. I mean, these shops all started off much more aggressive. Their roots are more aggressive than they've become in recent years. They also have this massive pile of capital that they have to deploy. It's becoming more difficult for them to find buyout targets. They have been actively looking for PIPE investments, but those are hard transactions to do. It's very expensive capital, and companies don't really get as excited about those situations. And to the point that Pete made earlier, private equity funds are organized around verticals, right? And they have large investment teams, know the sectors very well, know the ecosystem, and so they know all the companies and are able to approach them to offer, investments and operational expertise. And there was a recent situation where one of the most established private equity funds filed a 13D disclosing that it had, I think, about a 7% investment in the company. If you look at the 13D, it's made by the private equity fund's credit fund, so not the buyout fund. But if you look at the back of the 13D and the trading patterns, it looks a lot like what you would expect an activist to do. They acquired right up to 5%. Once they crossed the threshold of 5% and had to file, they very aggressively bought stock during that 10-day window before they had to file and tell the public that they just bought a big stake in the company. And to top it off, at the end, right when they got close to crossing the HSR reporting threshold, they then topped up their stake with derivatives so they wouldn't have to make an HSR filing. So it was, I don't know, to me it was very interesting to see them actually trading and deploying capital in that way. And the market reaction to that, stock shot up by like 16%. Right. And the market sort of cheering and rewarding that. And if you see that kind of reaction, I think it's just a matter of time before you see other private equity funds take similar approaches. I don't think you're going to see private equity funds running proxy contests and doing that anytime soon, although you have seen folks like Sycamore do that in more buyout focused plays. But I do think it's something that's you're going to see more and more of this year and next.
So these all sound like pretty durable trends. The looking for returns, the private equity, you get this experience of acting like an activist, it pays off. It seems like these things are going to continue, right, into the future. I don't have a sense that this is just due to particular timing in the market in 2019, right?
Yeah, the trend, particularly on private equity, I mean, and this is about 5 years ago, a partner at a large activist fund said, I'm not really concerned, my competition, I'm not concerned about other activist funds. I'm concerned about, one of the large private equity firms getting into my space. And they're doing that because ultimately they should win. You know, the activists that are doing better are the ones who are applying the private equity approach. And private equity they have the relationships, they have the industry expertise, they have operational expertise and operating partners. They have executives in residence that they can drop onto boards or into companies. You know, they have everything, except, you know, some of them need to build out a little bit on the public equity investing side. And so the precursors to a lot of success are already there. And I think you've seen that's part of the reaction, and they're going to be constructive, because they're not going to risk the rest of their business on running a proxy fight.
Got it.
So I feel this is pretty constructive for clients. Now, one of the things that we just talked about was one of the constraints is how do you deploy capital, and this has been we get into proxy fights or public activism situations, and everyone comes out of the woodwork saying, hey, I'll put a pipe in. Even sometimes, really aggressive activists will say that. And pipes, in order for private equity to kind of get over the hump, they have to really accept that they need to be common investors. There are certain situations where there's a need for capital, or there's some form of distress where a pipe may be the right solution, but it is expensive. And it creates a dynamic where it's not an inoculant, because if an activist comes, which is really the goal, if another activist comes in, they'll say, yeah, but those folks hold a different security, have different incentives than the rest of the shareholders. Right. And so the folks who are going to win at this are the ones who are solving for, I understand I have to be a common investor. I understand I may have to structure it as buying on the market first and taking risk, though I'm not fully aligned with management, from the outset, but that I'm going to get there because I've got a really good idea and a good investment thesis.
Okay, great. So the field's getting more crowded, more convergence, more overlapping kind of approaches. So you're at a company, and one or more activists shows up. Traditionally, what you would do at a company is you'd sort of say, let's learn as much as we can about each of these firms, or and then tailor a response based on it. But given this dynamic where you've got more folks coming in, and there's a bit of a convergence, and firms are playing different kinds of roles even, can't necessarily predict what they're going to be doing with your particular company. How do you deal with that? And Sharon, do you want to take a stab at giving our company some free advice?
Well, first you call us.
Right. Okay, that was only temporarily free advice.
So the activist is doing research on you, and of course, one of the first things your advisors and you are doing is research on the activist. So if you're up against an activist who's done this before, there tends to be a playbook. You know how they accumulate shares. If they're going to be, taking on derivatives too. You would have a sense if they're the type of activist that would, if they're nominating, do they leak the nominations? Do they leak the stake? So you're prepared really for any eventuality, but you have a sense of where this might play out. The professional activists, if you will, are also well advised for the most part. So they know the rules of the game in a sense, and you can anticipate a little bit better. When you have a lot of new entrants like we've been having in the past couple of years, it's unproven, so you don't really know where they're going to do. Sometimes they're a bit, they have nothing to lose. So if an activist is in a fundraising mode, you have a sense that they're going to be going public sooner because they need to start creating a name for themselves. It's also cheap to be an activist if you want to start making hay. All you need to do is call some activist reporters. Activism has its own beat, just like M&A, like anything else. So all you have to do is leak the news to them that you are taking a stake in a company. You don't even have to file a D or anything, and all of a sudden the company becomes in play and it becomes news. You can put out a tweet and it becomes in play. So when you're dealing with these unproven activists, it's a little bit harder to know where they're going to go. We also have activists maturing. So, the guys have been talking about the verticals. You have some sophisticated activists that are now coming out and saying, we want to help you as a company. You even saw the position that Ackman took in Starboard. It wasn't an activist position. It was, a position of where he was looking to make money, on the other side. So you have to anticipate and prepare and be ready for anything, but you should be researching your activists.
And be ready for surprises.
Be ready for surprises.
And, I know from firsthand experience, it can also be really challenging if you've got multiple activists in your stock and they all have different theses for your company. In some ways, it's kind of nice because it gives your board a little more flexibility, but it can also be really challenging because someone's going to challenge you no matter what you do. Right,
well,
Pete?
And it creates competitive tension.
Yeah.
And so there's sometimes in those situations where you can try to you'll find, particularly both or three or however many are public, where there will be a race to be a little bit more friendly and constructive because they want you to deal with them versus others.
Right.
But you got to tie it down before you come to resolution. Otherwise, there's nothing worse than having iterative fights, and we've been through that before in a number of situations. Sometimes you just can't get to yes.
Yeah.
But you try really hard to tie everything up before you settle or you come to a conclusion.
Yeah. Well, we're going to turn to the topic of ESG activism in a minute, which is a whole different sort of kettle of fish. But before we do so, let me take a pause to give the verification code to those of you who are looking for CLE credit today. Not that this webcast isn't its own reward, but if you want to get some CLE credit, the number to put on your verification form is 11991. Again, that's 11991. Okay, with that little commercial out of the way, let's talk about ESG activism. It comes in a number of different flavors, right? You get shareholder proposals. Maybe even more often you have behind-the-scenes discussion between investors and companies that result in ESG changes in disclosure of practice. Often it's governance issues, but sometimes sustainability issues are used as sort of wedge issues in going after companies. And this is all happening as ESG is sort of going more mainstream. So, Sharon, what's driving ESG activism these days, and what do you see unfolding in the future?
It's driving ESG investing. I think he probably hit on it. It's the flow of capital. It's probably driving it more than anything. ESG sells. There are opportunities you have certain funds that are index funds that have a small opportunity to also be able to hold better governance and better E&S companies. So that's why they're going there. You said in your open that ESG has become mainstream, and it is. If we learned anything from the activism of 16, 17, 18, is that no company is immune. We saw a lot of mega cap companies have to fight off activists. And ESG, so you think of the E, environmental, social, and governance, if you have strong ESG policies, it could be helpful to inoculating against an activist. It's not going to outright protect you, but all things being equal, if you have, activists out there, it will help keep some of your passives and longs on the fringe and in the supportive camp. We've seen a couple of funds go after companies specifically for poor E&S issues. You see that with renewables, with coal, energy, consumer product companies. You'll see it also, the idea of using sustainable packaging, healthier products, organic, that sort of stuff. But again, it's also a communications issue. So we have been working with companies a lot lately about just communicating what they are doing on an E&S front, because when you talk about this convergence, a lot of IR programs aren't set up appropriately to be able to talk about the ESG that they're doing. So there's a lot of low-hanging fruit out there where companies could be better communicating what they're doing on the E&S front. They could be satisfying, BlackRock's desire to see certain reporting under new standards. The companies are doing it, so now it's putting it out there so that way you can get credit for all the work that you're already doing.
Got it. So part of this is it's being aware of your potential vulnerabilities that people could use as wedge issues against you.
It's good hygiene.
It's
really.
good hygiene
right.
as well, right? I mean, it should be to some extent, like this webcast, its own its own reward. But let me ask a little bit of drill down a little bit more on the E&S side, because we have seen companies be targets of activism because there's been some perceived failure of the board in governance, right? And that governance failure, alleged, may play out in a failure when it comes to an environmental disaster or a data breach or something like that. Maybe Pete, start with you. Do you see environmental and social issues being real drivers of activism in the future? And if so, isn't that a kind of different sort of activism, because it's really, in many cases, looking at the long term, not just sort of the short-term return? So I'm wondering if you see E&S at some point bubbling up, and if it changes the nature of activism a little bit.
Yeah, so...
And there's no right answer here, so maybe there is, but we'll see if we get to it.
I'll take a shot. So,
Yeah.
so I think there's two pathways, and the first one you mentioned this in terms of a failure of oversight or governance crisis, let's call it. On E&S, there has historically been situations where there's an environmental disaster or cybersecurity breach or product safety issue. That has led historically to activism, because it implicates both. It usually impacts value,
Right.
and then it implicates, whether it's management or the board, some aspect of leadership or oversight. So we have seen that historically, and that will obviously continue. In terms of whether E&S strategy
Right.
will translate into activism focused on shifting, long-term shifting strategy, I think it's still TBD there. The only folks who are really doing that right now are, it's ValueX Spring Fund or Impactive. Jana did a bit with, Jana did a little bit with CalSTRS at Apple, but I think ValueX is the most prominent there right now. And what they would argue is they're they are working with companies who are open to changing their strategy. On power is a good example, going from coal generation or oil-fired generation to renewables. And what their message is, we are going to help you transition faster. You think that the market isn't going to allow you or give you license to invest in that. We think that that's a mistake, because we think that the ESG trend's coming. It's coming faster than you think. If you don't get out ahead of this, you're going to be valued significantly lower than the peers. And so we're going to give you that cover to do what you need to do to transition. So again, I think some folks are already seeing that. You may start seeing that become a more crowded trade over time, but it really depends on the skills of the fund, their outlook, and also how long they have capital locked up. I think both Spring Fund and Impactive have relatively long lockups, so they're able to deploy capital and not be as focused on losing capital in a quarter or 2 quarters.
Right.
So that's really critical. But again, I mean, ValueX has gone from $150 or $250 million to $1 billion in less than 2 years. So that's a pretty big proof point.
Yeah, and when you look at least the metrics, the ESG funds on the active side are one of the few bright spots, right, that haven't seen the outflows of capital that the other folks have. And so I think that's changing the dynamic. And I also think it depends on what you mean by activism. I think in the near term, I agree with everything Pete said, that I don't have a sense that now you're going to see as much of the traditional hedge activist funds pushing the E&S as the primary campaign thesis. It's a catalyst to other campaigns. But I do think you're going to see institutional investors, you are seeing institutional investors and long-only investors and others pressure companies to move to the forefront on E&S issues. I mean, they're going to hold companies accountable just like their investors and the UNPRI and others are holding their accountable. And you see that with the BlackRock letter, the State Street letter. So I think that maybe it's not activism, but I think that's here to stay, and it's going to be the more forceful in the near term, at least.
Yeah, and you will see it as part of the wedge. So
Yeah.
governance was historically, whether it was
And now
board.
sustainability issues may well be the sort of thing that say, look, they're not even doing a good job in this area. They're leaving value on the table. Yeah.
Exactly, or they don't care
They don't care,
about
right.
what you care about, large shareholders.
Right.
And I
Right.
mean, whether the BlackRock letter or the State Street letter, they're relatively balanced in
Mhm.
terms of saying
Yeah.
we just want more disclosure, um, as opposed to more substantive action, which helps them develop their views, both develop active ESG products, um, index and active ESG products, but also helps them, evaluate how they should develop their policies once there's better data, which we have pretty poor E&S data out there right now.
Right.
I think the BlackRock and State Street letter is really interesting because they're creating this private ordering that's going to provide more data. On that basis of that data, we're going to be able to make more substantive decisions, investing decisions. And so I think they're still early stages, but if you're Elliott or Starboard, you're going to look at it and say, if a company is not disclosing or is not making substantive changes that are in line with the direction of travel for those funds, you should support us because they don't care about what you, BlackRock, or what you, T. Rowe, care about.
And I think up until now, you've had ISS, and the reason why I think it's been so focused on governance is because you have these third parties that will evaluate and give ratings on the governance of a company. And now what BlackRock is really asking for is to have another third party give evaluations and ratings on a company on its environmental standards and on its sustainability standards. So now that you have this third party look at you, it's on the company to be able to showcase itself and to answer to it.
Right. A real challenge because each company is different when it comes to their environmental and social impact. So a real challenge, which is going to be a subject for an entirely separate webcast. One final question before we have a wrap up. So you're at a company and you know that activism is coming. You know that it's a more complex area than it has been in the past. So you want your board to be aware of all of this, right? At the same time, you don't want to spook your board, and you also don't want your board to only look at the world primarily through the activist lens, because you actually want them thinking in the long term and so forth. You don't want them just worried about who might show up in my stock this year. So what's your advice to a board to a management as to how to balance that? And you could say, well, general counsel, that's what you get paid the big bucks for. But how do you advise a general counsel or CFO or CEO if they're trying to figure out how much you let your board in on all of this and how much do you keep within management? Sharon, do you want to take a stab?
Sure. So it's part of, I would say, the natural dialogue. The board should be informed and the board should be aware. And when you talk about the distinction of talking with your investors and the portfolio manager versus the voting investors, it's a very different kind of dialogue. And oftentimes the board has to be the one on the front line because it becomes a conversation less about investment and strategy of the company and more a conversation about oversight and management and all of the strong G things that we were just talking about. So how do you keep the board informed? Through regular means. I mean, you would need to have the feedback loop that I think traditionally comes through CFO, IR conversations. Hopefully you have someone who has strong relationships at the table, being able to talk to your investors, both longs, activists, hedge funds too, and to understand as you're doing your normal course disclosures and discussions, does my proxy say what it needs to say? The questions that have been coming in, am I addressing it appropriately in my earnings? Do the investors know where we're headed? And then to help carry the board along so that way they see and understand why you're disclosing, the way you are. It all comes back to tight communications internally and externally and using the disclosures in the most appropriate way.
Got it. So cardinal rule, though, with your board is no surprises.
No surprises.
As much as you can, right?
Right.
Yeah. Well, look, thank you so much, Jim, Sharon, Pete. This has just been phenomenal. And thank you, everyone, for listening today. For those of you who are interested in the topic of M&A even more than you've heard today, On May 7th and 8th, the Conference Board is going to be holding a conference. The 2020 Merger Integration Conference will be held here in New York. And then we've got a similar conference in San Francisco on June 12th and 11th and 12th. In addition, if you want to see Jim again in a prior webcast on demand, we've got a terrific one that was called M&A, What Boards and Advisors Need to Know. So you can find that on the Conference Board website on demand. Again, for those of you who are looking for CLE credit, please download the CLE verification form, and the code again is 119911. And for those of you interested in CPE credit, please ensure you've entered your full name and email address and specified CPE in the space provided at the bottom of your screen. So thank you all for being here today. Thank you for joining us with this edition of Governance Watch.